Good morning.
Morning, Mr. Malepo.
How are you?
We're good, thank you. And you?
We are fine. We will resume where we left, which today we'll be dealing with the situation where the parent is selling non-depreciable assets to a subsidiary. But before we go there, let's just try to do a recap on our previous study unit where we were dealing with the situation of subsidiary selling the inventories. So I'm gonna open my Excel again. Just hold it on. Can you able to see the Excel now?
Yes.
Okay. Now we have subsidiaries, the issue of the inventories. So this will be a form of a summary. We've got a parent selling to subsidiary, and then underneath, mostly we'll be dealing with the unrealized profit. So the unrealized profit is from the closing inventories. And then while the realized profit is from the opening inventories. The realized profit is based on opening inventories. Then now it's a situation. Subsidiary selling to parent. So how are you going to account for those unrealized profit? Then one, your unrealized profit will affect the face value of our statement of financial position. So our SFP means statement of financial position. So, and in this case, what are you going to do with it? You're going to deduct it. So I'm trying to give you the summary so that when you study for your own exam, you know how do you treat these things. You're going to deduct this. And then again, the unrealized profit will affect your face value of the statement of financial of profit and loss. So the unrealized profit affect the face value of SPL, and here you're gonna also deduct. And then number 3, now the realized profit. The realized profit will affect your face value of the SPL again. Which in this case, you're gonna add because it's now realized. So it's based on the inventory which was sold to, outside the public. And then number 4, the realized profit on the opening inventory. So this realized profit on the opening inventory of the subsidiary. The opening inventory of sub, which subs mean the subsidiary, and will affect the retained earnings on the SCE. SCE, it will be the statement of changes in equity. And then which it will be deducted. So you're gonna subtract it, this one. And then number 5, the unrealized profit will be eliminated. Will be eliminated. And you will be doing those, it will be in the form of journals. So on your journals, so it will be the closing, like the closing inventory. Then you do the markup on it. And then the last one, it will be the unrealized profit. I mean, the realized profit will be eliminated on the journals, which it will be on the opening inventory. Will be eliminated on journals. That will be on the opening inventories. Any inventory. So this is the situation where the subsidiary is selling to the parent. Then now when the parent, this should be the parent selling to subsidiary. Sorry for that. In this case, is the parent selling to subsidiary. And then now we'll be dealing with the situation of the subsidiary selling to the parent. Subsidiary selling to parent. Now, when the subsidiary is selling to parent 1, you're gonna do, okay, the same situation applies, the unrealized profit, which is based on the closing inventory. Closing inventory, and then the realized profit based on the opening. Is based on the opening inventory. Now 1. The unrealized profit will affect the unrealized profit will affect the face value of SFP, which is statement of financial position, and then 2, the unrealized profit will affect the face value of the statement of profit and loss. And then 3, the realized profit will affect the face value of the SPL again. Which in this case, it will be added. And then the 4th, the unrealized profit will affect analysis of shareholders on that portion. Is either it can be since acquisition or the current year, depending on the date. Or the current year. So this one will be based on the date. And then lastly, it will be under 5. The realized profit will affect the analysis of shareholders again, which it will be on the same, either since acquisition or on the current year. So the realized profit will affect analysis of shareholders and this one, it will be you add, and then this one you will be subtracting. So you deduct for this one. And then, so both this, you have to make sure that you check the years. You check the year when the asset was sold. So check the years. So that you can know so you check the year here so that you know whether it's gonna affect your since acquisition or the current year. And then lastly, your unrealized profit will be eliminated. Will be eliminated. So this one, it will be based on the closing inventory. So it's important to know here what affect which portion. The realized is on the realized whether either it's on the opening or it's on the closing. So it's important to note those things. The same appears here. So that's the summary of our inventory part. So is there anyone who have a question with regard to that? And I will like to hear a response so that I know that we are on the same page. Lindy. Lindile. Okay, Tandega.
No question on my part.
Okay,
Thank you.
Stephen. Stephen. Okay, seems like Tandega, you're the only one who attending or listening now. People, I think they just open their teams and then they ran away. Maybe they're just here for the recordings. Okay, let's continue. So now, today we'll be dealing with a situation where now we are selling the non-depreciable assets. So I'm gonna also provide the same kind of this summary before we tackle anything on the study unit. So this one goes here. Click outside border. Then this one goes with this one. And then the whole thing, we're tackling the inventories. Okay, now we're gonna go to a summary or the points where the parent is selling non-depreciable assets to subsidiary. So now we are dealing with parents, or okay, let's say the selling of depreciable items. So the selling of the depreciable items, this is how it's gonna be treated. So one, we have a situation where the parent is selling to subsidiary and is selling the asset which is not depreciable. So now it will be a one, the unrealized profit will affect the face value of SFP on that particular asset. And then two, the unrealized profit will affect the face value of statement of profit and loss. Okay. This one, it will be deducted. It's important to note what do you do with that? Deducted. And then this one also, it will be deducted. And then the unrealized profit will be eliminated on the journals, which it will be the reversal of what was happened in the prior year. And then now we're gonna focus on the issue of subsidiary selling non-depreciable item to the parent. Now it's subsidiary. Yeah, selling non-depreciable item to parent. Subsidiary selling non-depreciable item to the parent. First one, unrealized profit will affect the face value of the SFP. Profit affect the face value of SFP. And two, unrealized profit will affect analysis shareholders. And then you have to check when the asset was sold. And then three, which whatever is happening there, it's gonna be deducted. And then lastly, it will be the unrealized profit to be eliminated. So here on the unrealized profit will affect the analysis of shareholders. It will only be on either since acquisition or the since acquisition or the current year, depending on the date. Since acquisition or current year, the date is the one which is gonna guide us. And then three, it will be the unrealized profit. Profit will be eliminated in the journals. Now, now we are dealing with the selling of the non-depreciable items. So if suppose they were selling the depreciable items, so it was gonna be realized through the use of that particular asset, or it was gonna be realized through the sale of the asset, depending on the situation. So in our case, we've got the selling of the non-depreciable items. So in this case, this one will be realized only through the sale. When those assets that are being sold to the public is where we're gonna able to realize the profit. So from our study unit or on the study guide, we've got page, when we turn to page 122, so we have an exercise there. So it means we'll be following these steps. And in that exercise is where on page 122, not 122, on page 127, we've got the situation where the parent is selling non-depreciable asset or item to the subsidiary. So we'll be now dealing with this method. this one. So we're gonna be following whatever is happening here on the unrealized profit, whether it will be added or deducted. So normally the unrealized profit, they are being subtracted and then the realized are added. So here's the unrealized profit, it's gonna be deducted also, and then the unrealized profit will be eliminated in the form of reversal in the journal. So let's go to our exercise on page 127. We've got a parent selling non-depreciable item to the subsidiary, and then we're given the statement of financial position of D&E Limited for the 31 December 2009. We're given the statement of profit and loss for D&E Limited, and then we're given the statement of change in equity. Then adjustment number one, they tell us that D Limited acquired its interest in E Limited on 1 January 2007, on which date the E Limited retained earnings amounted to 10,000. So that is the date of acquisition. The retained earnings was 10,000, and consider the carrying amount of the assets and the liabilities of E Limited to be equal to the fair value of thereof. So it means there is no goodwill in this case. And then on 1 January 2009, which is the current year, so it's gonna be the since acquisition. It's going to be the at acquisition, which is 1 January. Then the since acquisition will run from 2 January 2007 up to 31 December 2008. Then 2009 is the current year. So during the current year, E Limited, which is a subsidiary, bought a property with a carrying amount of 40,000 from D Limited. And D Limited, which is the parent, made a profit of 10,000. So that profit will be eliminated in the asset itself on the statement of financial position, and then that profit, which since is unrealized, will be deducted again on the statement of profit and loss, because in this case is the parent who sold to the subsidiary, because E Limited bought, so it means the D was the one selling to E. So it means in this case we are dealing with a situation of the parent selling to subsidiary. So we're gonna eliminate the profit from the statement of profit and loss, and then we're gonna do our reversal of the journals. So when we go to our analysis of the shareholders, this example is example one. Example one, where parent selling to subsidiary, then in this case, we've got the share capital of 100,000, which comes from our pre-adjustment trial balance, because they told us that the share capital is 100,000. So we're gonna do our analysis first. Analysis of shareholders, which one, it's gonna have the at acquisition, it have the since, and the NCI. So on our details, the at acquisition part, we have a share capital. So our share capital is sitting at 100,000, which it will be here. We have a total. And then on the date here, on the date of at acquisition, we determine the number of shares which are acquired by our parent. So we have considered that he acquired 70,000 while the shares issued is 100,000. So it means he's owning the 70%. So it will be the 70% here, and then the 30% on our NCI. So at 70% it will be 70,000, and then here it will be our 30,000. And then we've got retained earnings on the date of acquisition. Retained earning, which the retained earnings on the date of acquisition as per adjustment, on adjustment number 1, they said is 10,000. So here it will be 7,000 because it's the 70%, and the 3,000 because it's the difference. And then we have the total, which is the consideration given. So when we add the 2, they give us the 77. And then the consideration that was paid by D Limited is 77. So 77 is the consideration again. And then we don't have a goodwill. Then goodwill will be nil. Zero. Now we're gonna go to our since acquisition. So our since acquisition, based on what I told you in the prior year, the prior weeks, whereby our at acquisition is on 1 January in the 7, and then our since acquisition will run from 2/01/2007 up to until the 31 December 2008. That will be our since acquisition. So anything that happened here, it falls under this portion. So that case, it will be the retained earnings. The retained earnings of our E Limited on that day, which is the retained earnings balance on 1 January 2009, is the same as the balance on the 30 December 2008. 31 December 2008. So the retained earnings there, it was sitting on 16,000. So we have to say the 16,000 we less the one at acquisition, which was 10,000. So it means now we're gonna remain with the 6,000 on our total, and then since acquisition multiply, we're gonna take the 6,000 multiplied by the 70%, then it give you the 4,200. So on the minority part, it will be 1,800. We know how to get there. So now the current year it will be any movement between 1 January 2009 up to 31 December. So the current date will be only in the form of the profit. So the profit realized by our subsidiary, which is E. The profit for the year. So our profit for the year, it will be based on the movement from the subsidiary. The subsidiary realized a profit of 21,000 as shown in page 127. So you realize profit of 21,000. So you do your 70%, then it gives us the 14,700. And then the minority part will be the 6,300. So now let's draft our, so you can tell from this thing, there was nothing affecting our analysis of shareholders here. So now we're gonna go to our face value of the unrealized profit on the face value of the statement of financial position and to see how was this being treated. So we draft our statement of financial position. So we want to see if indeed the unrealized profit will affect the statement of financial position and it will be deducted. Now we check the solution there. We've got the PPE. So on our SFP, draft of SFP, on the non-current assets or the asset itself, then on the non-current, because they said it's a property, so it will fall here. You see that on our PPE, we say PPE, it will be the one for the 180 from the subsidiary, I mean from the parent. Then you add with the 150, the one for subsidiary, and then you have to deduct the 10,000 profit that was realized. Because they were told that out of that asset which was sold for 40,000, with a carrying amount of 40,000, they made a profit of 10,000. So that profit of 10,000 need to be deducted. So that's why it's shown here by the summary that I gave you. You can see now that the unrealized profit is now being deducted. And then from there, we're gonna go to our SPL. So when we draft our SPL, it will be on the profit before tax, as they told us that when we'll be dealing with the SPL, the only information will start from the profit before tax. So our statement of profit and loss. So on our profit before tax, so we're gonna have the 20,000 from the parent, from the parent plus the 30,000 from the subsidiary, and then you less the profit realized by the profit which is unrealized based on the assets sold by the parent. So you didn't realize the profit, yes, so it needs to be deducted. So it will only be realized when the asset is sold to any person outside the public. So that's why we're gonna deduct this 10,000. So our 10,000 need to be deducted. And then on the, which it will be going hand in hand with this, the unrealized profit will affect the face value of the SPL. So it's where we're gonna deduct this unrealized profit. And then the last one, which will be the unrealized profit, will be eliminated in the form of journals. So now we're gonna, who realized profit in this case? The profit was made by the parent, which is the parent is delimited. So we're gonna go to our journals and then we eliminate that portion. So it will be eliminated in the profit from the sale of property. Who made the profit? It was D. And then normally, remember, elimination journals. So our journals prior the elimination, so our individual journals, they were like these individual journals. So it was debit, DR, and then the CR part which is credit. So on the books of D Limited, he sold the property. So when he sold the property, he made the profit. So the profit in this case, it was credited. So we credited the profit, which it was the 10,000, and then we debited the cost of sale. Let me check something. The cost of sale. So on the debit, it was the cost of sale with 10,000. So here's the books of D Limited. The one which was selling. And then on the books of E Limited, individual journals of E Ltd. So E Limited, on his books, he got an asset. And then out of the asset that he realized, there was the 10,000 that he paid, which is in the form of the bank. So his bank was deducted by the 10,000. And then on the other side, what was he doing? He was doing the purchases. On the other side, he was increasing his assets, which it will be in the form of is the inventory. But in this case, he was not buying the inventory, he was just buying the asset. So we don't know that asset, which was a table or was a furniture or was a vehicle. So we'll just say the asset itself, which we're gonna just call it an asset, which it will be the asset on the debit side or that property. So it's the 10,000. So now you're gonna do the elimination. So your elimination will based on the property itself versus the profit. So whatever was debited now it's gonna be credited, and then whatever was credited need to be debited when you are doing your elimination journals. So in this case, my profit, it was on the credit side on my individual journals. Now I'm gonna make it on the debit. So it means I will say profit on sale 10,000 on the debit. And then here my asset was debited. So now I need to credit that asset, which is still be asset or property. So it needs to be credited by the 10,000. So it means it's the reversal of what was done here. Now we are reversing this. So up to so far, is there anyone who have a question? Question? We are all clear. I will start with you, Tandega.
So far, yes.
Okay. Stephen, are you clear?
Yeah, so far we're on the same page.
And then Slindile. Glenrose. Okay, let's continue. Then that was this part, this portion, the one we're dealing at, the first one. So now we're gonna have a situation where now the subsidiary is selling non-depreciable item to the parent. Okay, now example 2. Now is the subsidiary selling things to the parent. Just see example 3. Subsidiary selling non-depreciable item to parent. So in this case, means subsidiary is the one realizing a profit. So from the example 2, we've got the abridged trial balance, statement of financial position, together with the abridged statement of profit and loss. And then we have the statement of changes in equity. Then we are told that on Q Limited acquired its interest in R Limited on 1 January 2007, on which date R Limited retained earnings amount to 10,000 and consider the carrying amount of the assets and the liabilities of R Limited to be equal to the fair value thereof at the date of acquisition. So on 1 January 2008, which is the last year, it's not the current, it's the last year, Q Limited bought the property with the carrying amount of 40,000 from R Limited and made a profit of 10,000. So our Q bought from R. So R is the subsidiary, which is the one selling. So based on what I did prior, so now we'll be tackling this kind of the movements. Or where are we going to deduct the profit from the face value of the SFP? Where are we going to deduct the profit from the analysis of shareholders? And then where are we going to do the reversal of the journals? So we're going to do our analysis. Analysis of shareholders. We've got the total. We've got the at acquisition. And then we've got the and then we've got the NCI part. So it's share capital, which will be on the at acquisition part. The share capital, as we got from the information on the prior adjustment trial, on the abridged statement of financial position, we have a share capital of 100,000 as represented on page 132. And then by 70% because he acquired the share capital issued by the subsidiary, which the subsidiary was R. He issued 100,000, and then Q acquired 70,000 of ordinary shares, so it's 70%. Then 100 by 70,000, and then we've got the 30,000 as our NCI. Then retained earnings. On the date of acquisition, when he acquired, when Q was acquiring R, retained earnings was sitting on 10,000. Then it will be 7 on the at acquisition and 3 on the NCI. So we have a total, which it will be the 77. And then the consideration given by our company, which is Q consideration by Q, it was 77 also. And then the NCI, which is the goodwill will be 0, because whatever we acquired is the same as what we get. Now, we have since acquisition to beginning of current year. Now, since acquisition will fall under the date 1 January 2007 up to 31 December 2008. So anything that happened there. So on our retained earnings, we have the retained earnings. So our retained earnings was sitting on the beginning of the current year for R. It was sitting as 16,000. So 16,000 less the 10,000, the one for this 10,000, the one for add. And then we less again the profit, because R realized a profit of 10,000 when he was selling the assets to Q, as per statement seen on page 133, adjustment number 2. So we less the 10,000 there. So when we do our calculation, it gives us a negative number of 4,000, because normally here on our analysis, we have a positive number. But in this case, it gives us a negative number of 4,000. We're going to do the same thing that we used to do, multiply by the 70%, which would give us the minus 2.8. And then this side it will be minus 1.2. Then current year, the movement happened during the current year. It was only the profit realized by R. So R realized the profit as per statement of profit and loss on page 132. He realized a profit of 21,000. So it will just be 21,000 here. So out of that 21,000, he need to give the 14,700 to the parent, and then the 6.3 will remain with him. So that will be our analysis of shareholders. But suppose the asset was not sold on 1 January 2008, instead was sold on 1 January 2009, the profit was going to be deducted on the current year instead of the since acquisition part. It was not going to be deducted on the retained earnings. It was going to be deducted on the current year. So just note those differences. Are we clear there? On this portion, where to deduct the profit? A confirmation? Are we clear? Must I start calling by names again? Stephen? Hello?
Can you run through it again, Mr. Molep?
Sorry?
Can you just go through it again?
This example.
On my part, it's a bit confusing because of the negative balance. So if you can just state it again.
Okay. On the retained earnings, we have a balance. We had a balance of 16,000. That was from the statement of changes in equity on page 133, right?
Yes.
And then we minus the 10,000. The 10,000 comes from the retained earnings at acquisition on page 133, adjustment number 1.
Okay.
And then that another 10,000 that we deduct is because of subsidiary, which is R. He was making a profit because of the asset he sold to Q. So we need to deduct that profit, and the profit was realized on 1 January 2008, not on 1 January 2009. That's why we deduct it here. But if the profit was realized on 1 January 2009, it was going to come on the current year. So it means we were going to have a profit of 21,000 less the 10,000 because the asset was sold in the current year. That's why, if you remember at the beginning of my presentation, I said when you are dealing with the portion of the inventory side, especially for a situation where the subsidiary is selling inventory to the parent, you must note this. That's why I said you must check the year. It's important to know where you're going to deduct that part. Are you clear now?
All right.
Yeah.
Okay. Yes, understood.
All right. And another one, is there anyone who's confused by the 10,000 to the extent that it's going to end up creating a negative number? We are all clear, okay? Now we proceed further. We have, we're going to do our movement. We're going to do our consolidations. So on our consolidations, let's start with the journals. So on the journals, it will be this. Now we have the individual journals of each one. Individual journal. So it will be Q Limited and also R Limited. So on Q Limited, debit and credit. So the person who was selling is Q. R. R was the one who was selling. So R will realize a profit. So in this case, Q received an asset or property, which it will be in the form of the 10,000 part. And then he used his bank to acquire that particular asset. And then on the R Limited, because he was the one selling that particular asset, he made a sales $10,000. And he also the profit So the things to be eliminated here, it will be the profit part, and the property side. So the profit is now going to be debited, and then the property is now going to be credited because it's the reversal. So on the journals of the consolidated, we're going to have on the debit side, we're going to have a profit. $10,000, and then which, remember, the profit affect what? The retained earnings, because it was the retained earnings on the prior year. Because remember, this 10,000 affected this. It affected the retained earnings. So now it means on our here we can just write, because it's the prior year, it will be the retained earnings. Because normally the retained earnings increase on the credit side, but because we are reversing it, it's going to be on the debit side. So the retained earnings, 10,000, and then the property which was now on the debit, it must now come to the credit because it's the reversal. So on the credit, it will be the property, 10,000. So that is the reversal of the whole thing that was happened on the individual journals. Now we do our SFP. SFP means statement of financial position. So on our SFP, we're gonna have the property, PPE. So on the PPE, on page 132, we have 180 plus 150, and then we're gonna less the profit because the profit realized is 10,000. Then we're gonna sit with 320. So this is the bullet point number one, the one I said when the subsidiary is selling to the parent, the unrealized profit will affect the face value of the SFP, then it must be deducted. Indeed, we did deduct it because we less the 10,000. So now we're gonna go to the second portion, whereby we say the unrealized profit will affect the analysis of shareholders. So this one we already done it. So the bullet point number 2 and number 3, we already sorted them out because this one is affected our since acquisition, and then the unrealized profit was eliminated in the form of reversal. So it means bullet point number 1 and number 2, number 3, we already dealt with when the subsidiary is selling non-depreciable item to the parent. So the remaining is just to consolidate what is necessary to be consolidated. So it means all the figures will just be the same. Our profit before tax is going to be the 20,000 plus the 30,000, and then the 6,000 plus 9,000 will be our income tax. And then we have a new profit, which it will be 35,000. And then from there, we go to our retained earnings, to our statement of change in equity. The 200,000 comes from the parent because the one for subsidiary was eliminated. And then on the retained earnings, we have a situation of the 15,000. The 15,000 is the balance of the Q Limited as shown on page 133. Then you're gonna add it. You're gonna subtract the 2.8. The 2.8. The reason we subtract is because it's sitting on minus. Because normally we were gonna say 15,000 plus whatever amount if it was on the positive figure. So it's important to show, since now it's sitting on the minus, it must also reduce our retained earnings at the beginning of the year in our consolidations. I don't know if I'm clear there, because normally we add it. Am I clear? on the minus portion. Stephen?
Yeah, I heard that. I understand that.
Okay, Slindile? Slindile?
Yes, actually, I understand that.
Okay. Then that is the summary of a situation where the parent is selling a non-depreciable item to the subsidiary versus a situation where the subsidiary is selling non-depreciable items to the parent. So the main thing which is important is those things that I presented at the beginning. If you can know that when you are dealing with inventory, this is how you need to tackle your situation. And then if you are dealing with inventory, the parent selling to subsidiary, this is how it's gonna affect your statement. And then if the subsidiary is now selling to the parent, this is how you're gonna tackle this. And then if it's a situation where the parent is selling a non-depreciable item, so here it should be the selling of non-depreciable. If the selling of non-depreciable items, when the parent is selling to subsidiary, so you must know that the unrealized profit will affect their SFP, it will affect your SPL, and then the elimination of those unrealized profit. But if the subsidiary is now selling to the parent, it's gonna only affect the SFP, and then the others, they will be affected on your analysis of shareholders, either on the since acquisition to the beginning of the current year or on the current year, depending on the date of the asset where it was sold. Now, the last portion, which it will be this the last learning unit. I mean, the last portion of this learning unit, number 7, it will be a situation where we are selling the depreciable items. So now is the selling of depreciable items. So this one, they have their own way to be treated. So 1, the unrealized profit will be eliminated. And then 2, the profit realized. So it means if it happened that it's either they can sell the asset or they use the asset. So the realized profit or the profit, but since I sold the assets to my subsidiary or to my parent, I've created an unrealized profit. But because I sold the asset which is depreciable, so now I have to realize that profit on the later stage. So the profit will be realized by means of, will be realized by means of the 2 ways. By means of selling the asset or use the asset. So the selling of the asset, it will be selling of the asset will be made to public, which it will be the people outside the group. People outside the group. And then Another method that you can realize the profit, it use so in this case, the asset will be used within the group, and the realization will be done in the form of depreciation. The realization will be done in the form of depreciation at the same rate which depreciation are being provided within the company. Then let's see how does the selling of the depreciable item affect our statement. So let's have a look on our exercise, and then I will give you the summary at the later stage. So if you go to page 137, we've got an abridged statement of profit and loss and the abridged statement of financial position together with the changes in equity. So in that case, they say we've got A Limited and B Limited, which is a subsidiary. And then they said on 1 January 2007, as page 138, is the date which B Limited retained earnings was 55,000 because it's the date of acquisition, and the carry amount of the assets and the liabilities amount to the fair value thereof on the date of acquisition. Then on 1 January 2008, B Limited purchased. So here is on the following year. It's not on the same year. It's on the following year. On 1 January 2008, B Limited purchased all its machinery from A Limited at the cost plus 33%. 33.3%. Then both companies write off depreciation on machinery at 10% per annum according to the straight line method. Now, we see that, okay, we purchased a machinery from A Limited at cost plus whatever percentage. And then now we have to know how many machines were purchased. So the machine were purchased all on 1 January 2008. So it means all the machineries which B Limited have, all the machines, they come from A Limited. So the machine which they are owned by B Limited, as at statement of financial position, we see the 20,000 on cost price. And then we have a carrying amount of 16,000. Now we're gonna do our profit so that we can know how much profit was realized by this guy. So we're gonna say the cost. So analysis of example. So in this case, on this example 3, I'm gonna only tackle the situation of the parent selling to subsidiary. The one of subsidiary selling to the parent, I will tackle later. I think it will be during next week. And then we can also do maybe one of the exercise. And then, yeah, we'll see as time goes by. So analysis of example where parent L depreciable asset to subsidiary. We have a cost of the asset is 20,000. 20,000. Now the profit at markup. Profit is at 33.3%, and they said is at cost price plus. So it means the profit realized in this case, it will be cost of 20. We add markup, which is 33.3 there, 33.3%. So the 33.3% of the 20,000 is how much? Which is 666. So now, because they say it's at cost plus, so it means we're going to divide this by the 133. So we'll say that 20,000 multiplied by 33.3 divided by 133.3, which is going to give us the 5,000. So it means when they were selling this asset to that particular person, they sold it for 25,000. However, its cost was 20,000. So it means there was 5,000 profit realized. So this is the profit made by our parent, which our parent is A Limited. Then we're gonna say 20,000. So the 5,000 is the profit realized. Now is the one which we're gonna be tackling here. So we were told that this asset, it will be realized through the use. So the usage, it means that profit it will be realized when the asset is being used in the group. So they purchased the asset last year, and then now we have to account for the current year. So on the current year, let's start with our statement of profit and loss. I will start with the statement of profit and loss. So under our statement of profit and loss, we have the GP, which is the gross profit, which is 20,000 for the parent plus the 10,000 for subsidiary. Which equal the 30,000. And then we've got admin expenses. So our admin expenses, it will be the one for subsidiary and the one for the parent, which is shown as depreciation. So it will be the depreciation of 3,000 plus the depreciation of the 2,000. Now, because we had this 5,000, which the 5,000 was the profit made on 1 January 2008. So from 1 January 2008 to 31 December 2008, the profit was now realized when the asset was being used. So, and they told us that the depreciation for the asset is 10%. So now we're gonna determine the 10% of this, the 10% of our 5,000, which is the profit. So the 10% of our 5,000 profit, it will be 500. So this profit will now be realized through use. The realization will be through use. So it means now the asset is being used by A Limited because he got it from, I mean, the asset will be now being used by the B Limited. The asset will be through use by E Ltd. So B Limited, he used how much of the profit realized by A. So now we want to know how much profit was used by B Limited. How much of the profit made by A Limited TD used by B Limited. Remember, because now the machine is sitting with B Limited. So we found that B Limited only used the 10% of the profit made by A Limited. So the profit made by A Limited was 5,000. So multiply by the 10% of the depreciation used by the B Limited when he was using the machine. So the 10% of that 5,000, it will be 500. So this 500 is the one to be deducted from our depreciation because this is the depreciation of both A and B Limited. However, now since B Limited is having the machine, he must deduct that depreciation because it's the profit which is will be now realized by A Limited. That's why they say 3,000 plus 2,000 minus the 500 of the profit. Because this 500, it comes from this. Are we clear here? Glen Rose? Glen? Okay. Tandega?
Yes, we're clear. But I have just one minor question on this. Why is it not recorded as depreciation anymore, rather as administrative expenses?
No, it's still regarded as a depreciation. Remember, when we are presenting this via what we call it via IFRS, we're not gonna write depreciation on our statement of financial of the profit and loss. We write administrative expenses. Remember, when we were doing the FAC2601, I don't know if I tweeted you or I don't know when, but there is a formula that we used for it will be the gross profit. Then we have the other income. Then we have administrative expenses. Then we have a distribution expenses. Then we have the other operating expenses. So we don't write them by the line item individually. We combine them. I don't know if you get me.
All right.
Yeah, so that is still like under the administrative expenses, you will find that it will be the depreciation, salaries, wages, those things, but we group them all together and we call them administrative expenses.
All right.
Yeah.
Thanks.
Okay. So now we remove the 500 from our admin expenses. So it means now on our statement of financial profit and loss, we'll now be sitting with the 4.5. So it will be the 4.5, which it must be subtracted here, yes, because it's an expense. And then we go further. When you check on the income tax expense is fine. It will be the 5,000 plus the 2,000, the 1 year subsidiary. Then there's no any movement there. And then we go to the total profit, which it will be the 18,500. Then to account the following expenses, which is depreciation of the 3,000 plus the 2,000 minus the 500, because the 500 was realized. This is the 500 on the current year. So here it will be the 500 for 20.8 and the 500 again for 20.9. So this 500, the one we are deducting, is for the current year. We are focusing on the one for the current year. So this 500 here is based on the current year, this one. But when we check on the, when we go to the statement of financial position, you will see that they said in the machinery is 30,000, which is the cost, plus the 20,000, which is also the cost of the subsidiary, then less 5,000. 5,000 is the total profit realized, the total profit made by A Limited. So we deduct that profit made by A Limited, then we deduct our accumulated profit, accumulated depreciation. So our accumulated depreciation will be the 6,000 plus the 4,000 as normal. So the first 500 that they are deducting is from the prior year, the 2008, because it's the accumulated depreciation of the prior year based on the realization of the assets sold. And then another 500 is based on the current year, because now we are doing the end of the 2009. So the 500 was for the 2008 and another 500 was for the 2009. That's why they deduct 2,500 there, because those 2,500, they were called the accumulated depreciation, the one for the last year based on the profit and the one for the current year based on profit. Is it clear? Are we clear?
Clear on my part.
Okay.
Clear on my part.
Then that's how we account this 500. And from there, when you go to the balances on the statement of, because the other things, they will remain the same, there's no changes. Then when you go to the statement of changes in equity, the share capital will be the 50,000, the one for the parent based on the A Limited, because the 30,000 will be eliminated via the acquisition part. And then the retained earnings of the 16.7, it came as a result of the 5,000 for the retained earnings. Let's see. The retained earnings parent to subsidiary. There is something that doesn't make sense here, because when they say on the, okay, when we go to our calculation 3, we have the retained earnings of, let's start with the retained earnings of A Limited. We have the retained earnings of A Limited, which is 30,000 as given. Amount the same exercise. Just hold on, I want to check something. Solution 3. Okay, the retained earnings of A Limited as given from the statement of change in equity on page 138 is 18,000 is given. So we have the retained earnings of 18,000, then we less the profit from the sale of machinery. The reason we less the profit from the sale of machinery is because the profit was made on the retained earnings on last year they made the profit last year. So remember, the last year profit, they're going to be accumulated into the retained earnings. So they will form part of the retained earnings in the following year. So we say the retained earnings given is 18,000. We less the profit of 5,000, the one which come from the last year. Then the depreciation Can you able to hear me? I'm switched off from my PC to the one of Greg. Tandega?
We hear you now, yes.
Okay, let's continue. We were on page, just hold on. Okay, let's continue. We were on page 135. I mean, not 135, the one of the retained earnings on 141. Yeah. So we had the given balance, which is 18,000, which comes from the statement of changes in equity in page 138, right? And then we less the profit from the machinery, the profit which was realized because this guy purchased an asset on 1 January 2008. So it's the last year portion. So remember, our profit, they have to go to the accumulated profit. And remember, we had changed the name from accumulated profit to retained earnings. So those profits from the last year, they need to go to the retained earnings. So since this profit is not yet realized, we have to deduct it because I said the unrealized profit, they need to be deducted. That's the reason they minus it. Now, because now on the 2000 and now we are on the 2009, they realized the 500 from the 2008 year. Remember when I was doing the calculation, I said the 5,000 multiplied by the 10%, which would give us the 500 for the year 2008 is for the first year. And then for the year 2009 is another 500. That's why we had a double 500 on our statement of financial positions. But here we're going to only eliminate one. We are eliminating the one for the year which it was used. And the year which it was used, it was last year on the year 2008. That's why they only deduct 1,500. So the 500 for the 2009 will be deducted in the retained earnings for the year when we'll be doing the financial statement for the 2010. I don't know if I make point there. Am I clear there? So it will be realized on a step by step until the whole 5,000 it will be finished. So it means from our 4,000 from our 5,000, we are now remaining with 4,500. So the 4,500 is the one which can be eliminated based on the year 2009. We are fine there. Stephen?
Yeah, I think I get it.
Glen Rose, you do get it. Tandega?
Yes. Thank you.
Okay. Now let's move forward. So now we have we're gonna sit with the retained earnings of A Limited of 13,500. So the 13,500 we're gonna add with the 3.2, which the 3.2 will be the one calculated from the analysis of shareholders from the subsidiary point of view, because it will be the retained earnings of the 9,000 minus the 5,000. Then in this case, you see now it's positive. It's no longer minus because it's 9,000 minus the 5,000. Like the 5,000 comes from the one at acquisition. So it have a positive figure of the 4,000. So that's why here now we're gonna add the 3.2. But suppose it gives the minus, we're gonna say 13,500 less the 3.2, like the way we did in our prior example. So we're gonna say the 13,500 plus the 3.2, then they give us the total retained earnings of 16,700. So the 16,700, it will be our retained earnings at the beginning of the year for our consolidations purposes. Then we add with the profit for the year, and the profit for the year will come from the group, whereby we had our 18,500, and then we do the one for the attributable to the owners of the parent, and the one for non-controlling interest. So the owners attributable to the parent, it was the 17,300, is the one we're gonna add on the retained earnings on our statement of change in equity. So we're gonna say 16.7 plus the 17.3, then they give us the 34,000. Is it clear? Tandega, you are fine there.
Yes, fine.
Okay. So that's how we tackle the situation where our parent is selling a depreciable item to the subsidiary. So the format, it will be the same, like the way they're gonna affect either the face value of your statement of financial position or they affect the face value of the SPL. The method will be the same. The only thing is the portion of the depreciation. The depreciation is the one that now need to be accounted when you are dealing with this. So you only realize depreciation through use. So, and you're gonna realize through use by means of the percentage we are using to determine the depreciation. So if our depreciation is 10%, so it means our profit will be realized by the 10%. If we write off the depreciation by 25%, so it means the same profit will be realized by means of 25%. So we follow the pattern that we are using for the normal depreciation when we'll be realizing the profit of the depreciable asset. So let's go to the comment part, because I think it will be the one important. Because after the comment, it will be the situation where the subsidiary sell to their parent. But that one I'm gonna tackle it next week, so that we're gonna do it, and then we do it together with the summaries for both subsidiary selling to the parent and the parent selling to the subsidiary, and do one exercise where it will be consolidating everything that we dealt with the learning unit number 7, so that at least we can have a clear understanding of this learning unit. So let's go to our comments then. They said as B Limited purchased all its machinery from the A Limited at the beginning of the previous year, which is last year, the year of the 2008. we should debit the retained earnings to eliminate the unrealized profit. A Limited sold the machinery, which is the parent, and made the profit. Therefore, A Limited retained earnings need to be decreased or be debited to eliminate the unrealized profit, because the whole 5,000 it need to be deducted. Then we add it back with the 500, which it will be the one realized. Then B Limited bought the machinery. Therefore, B Limited machinery needs to be credited to decrease it, as it contains the profit amount that needs to be eliminated. That portion is seen on your journal. If you check the journal on the page 142, we've got the retained earnings on the debit side of 5,000, because initially it was a profit on the credit side. It was a profit of 5,000, and then on the debit side, it was the cost of sale of 5,000 when we're doing the individual journals of A Limited. And then when we go to the accumulated depreciation part, we have the 1,000 on the debit side. This 1,000 comes as a result of the 500 from the 2008 plus another 500 of the 2009. So the 2009 500 will represent the depreciation, but the 2008 profit, the one which we realized, it's gonna represent the retained earnings, because it's the depreciation of the last year or the profit of the last year, so which is now gonna affect our retained earnings. So when we add those two 500, then they're gonna give you a total value of 1,000. That is the summary of the bullet point number 1. Then is when now they say, therefore, the retained earnings, it will be the 5,000 on the debit and the machinery on the credit. So that is the elimination part. So now on the bullet point number 3, they say in B Limited individual financial record, B Limited depreciates machinery that still includes the unrealized profit of 5,000. Therefore, the excessive provision is made for the depreciation. To eliminate this, we debited the accumulated depreciation. We normally create the accumulated depreciation when we do our depreciation in a year-to-year basis. But because now we are doing the elimination, we're gonna deduct that. We're gonna deduct the accumulated depreciation. So which now, since in most cases it goes to the credit side, but because now we are eliminating, it's gonna go to the debit side. So in this case, the amount is calculated as follows: the 5,000, which will be the unrealized profit, multiplied by the 10%, which, as I said, is the depreciation rate. So if they say depreciation rate is 25%, you're gonna use the 25%. If they say it's 20%, you're gonna use the 25%, 20%. So the bullet point number 4, they say, as A Limited made the profit, and the profit was eliminated in A Limited records, everything that affects profit or retained earnings will occur in A Limited records. As this machine is used, so as I said, the profit, it can be realized either through use or either through sales. So in this case, our profit is realized through use, because since the machine is now being used by B Limited, and again, not forgetting that B Limited and A Limited, they form one group. So as A Limited made a profit and the profit was eliminated in A record, everything that affects the profit on the retained earnings will occur in A Limited records. And in this machine, as this machine is used, the profit that was unrealized in the books of A Limited will now become realized each year through the use of the asset over the remaining useful life of the machine at the rate which is determined by the 10% of the depreciation. Therefore, we should credit the retained earnings or profit again, since the profit is being realized gradually through the use of the assets in the current year. As we credit A Limited depreciation and we credit the retained earnings of A Limited for the previous year. Therefore, we're gonna have accumulated depreciation of 1,000 on the debit side, because we are now realizing it back, of 1,000, and the depreciation of A Limited of 500 based on the current year, and the retained earnings of 500 based on the prior year. That's why we have the debit side of 1,000 and the credit side of the 500. So that's the summary of our example on the situation where the parent is selling asset to the subsidiary. So next week we'll be dealing with the situation where the subsidiary is now selling a depreciable asset to the parent, so that we can see how does it have the impact on our financials. And again, I'm gonna give you the same summary of the situation where the parent is selling to the subsidiary, and again the summary of where the subsidiary is selling to the parent. Is there anyone who have a question? It can be regard to the lesson itself, or it can be regarding to the module itself. Tandega?
No question.
Okay. So I'm gonna give you the summaries of those, the one parent selling to subsidiary and subsidiary selling to the parent, plus the summaries of the one of the inventories and the summary of the parent selling non-depreciable items, either the parent or the subsidiary. I'm gonna also give, which it means next week I will give you the whole summary of this learning unit number 7, and how do you tackle it when it comes to the financials, like where does it affect what. So I'm gonna do that in the form of a slide so that we can understand it, and then you will save the slide on your side. And then I know that I got the numbers. I got the 2 numbers, the one for Mudise and the one for Bethlehem Rose, for group creation. So I'm gonna, there are another one who need to be added on the group, which I think I'm gonna create today, that group. You can forward your numbers so that I can create the group, and then I have to share some of the slides plus the presentation, this class one-on-one classes presentation to you via email, so that you can able to follow up where did you get the amounts and what makes us to calculate these values. So if you want to be included in the class, you can forward your numbers to me via WhatsApp, which it will be, the number is 072 453 5744. I will repeat, the number is 072 453 5744. You just write your name and FAC2602. Then I know that you want to be added into the group. Anyone having a question? Stephen?
Oh, sorry, can you please just repeat your cell number so that I make sure I got it right?
Okay, it's 072 453
Okay.
5744.
Yes. Okay. Thank you.
Okay, so you can just type Stephen, then FAC2602. So I know that it's you want to be added into the group.
Okay. Thank you very much.
And that will be the end of the class for today. With that section of the situation where the subsidiary sell to the parent, it will also be longer. So I can't tackle it in the 5 minutes or so. So we're gonna do it next week, which it will be the situation where subsidiary is selling to the parent. Then we combine with the exercises where it's gonna include everything that we studied on the learning number 7, either subsidiary selling to the parent or parent selling to the subsidiary, whether it's an inventory, whether it's a non-depreciable asset or it's a depreciable asset. They will all be tackled in one exercise next week. So I will choose whether I go for exercise 1 or exercise 2, but I will check the one which can have all the complexes, which by the look of eyes seems like it's the one, exercise number 2. Seems it's like the one having everything. So next week will be the example, the last bit of the example, plus exercise number 2. Yeah. And then from there, we'll see how does it goes. Up to so far, units are just published that the exam will start on the 6th September, but we don't know the date yet. So we'll assume that the exam will start early September for this module. But until such time where they give us the full date, then we have an understanding that we can relax or we can do what. Because now, suppose the exam start on the 6th, so we are still having almost 3 learning units, learning number 8, number 9, and topic number B. I don't know if we can able to finish, but we'll see as time goes by. So it was nice being with you. Hope to meet you next week. Please be safe. It's cold today.
Thank you, Mr. Malepo.
Same
Thank
to you.
you,
Thank you.
Andeka. Thank you, Stephen. And thank you very much, Glenn Rose.
Thank you. Bye.
Okay,
Bye.
bye. Okay, I think you can stop the recording part.